Welcome. This is the Insider's Edge to Real Estate Investing with James Nelson, the principal and head of Avison Young's U.S. Investment Sales Group, and his co-host, Kim Troller, from his investment sales team. In this program, you'll learn game-changing strategies to outperform the market. James will teach you how to source, execute, and capitalize on the best real estate opportunities in New York and around the world. Now, here are your hosts.
Welcome back to our new season of the Insider's Edge to Real Estate Investing. I am your co-host, James Nelson. I'm head of U.S. investment sales here at Avison Young, along with Kim Troller, who is also working on our USIS investor initiative. And today we are here with Agustin Barrios Gomez. This is episode number 228. We're going to be talking about generational wealth. And today you're going to learn about gaining that insider's edge in different markets and finding the right tenants in this conversation. Agustin is the founder and president of International Capital Partners. ICP has built a portfolio of nearly 90 properties across 15 U.S. markets by focusing on stable, cash-flowing industrial and suburban corporate office assets.
You'll hear how real estate serves as a tool for generational wealth through tangible income-producing assets. Agustin discusses how ICP works with trusted local partners, leverages regional banks for debt, and structures each investment to align with both the fund and its operating partners.
You know, Kim, what I really appreciate about what Agustin is about to tell us is that he's really figured out the fundamentals of real estate investing. In fact, he even said that he's not looking for any future upside. I mean, it's really about the cash flow today, boiling down to the fundamentals for wealth creation, look to outperform, get some beta as well. So I think this is going to be a very interesting conversation for our listeners.
Absolutely. And he's very transparent about that too with his investor reporting and just kind of telling them how it is. One of my favorite things about Agustin too is his diverse background in politics and public speaking, about foreign investors. So he's a very well-rounded guy, and I think he brings a very unique perspective to the industry.
Well, as always, you can go to jamesnelson.com. That's where you can find the show notes. That's how you can figure out how to connect with Agustin. And then we're going to have a short word from our sponsor. We'll get right into our interview with Agustin Barrios Gomez.
Avison Young's United States investment sales platform executes on multifamily office, retail, development, and specialty asset transactions across top U.S. markets. As experienced leaders in the industry, our integrated national team is here to help you make informed investment decisions, whether advising on your current holdings or identifying new opportunities nationwide. Our one unified platform is built on unparalleled collaboration and connectivity across 120 full-service offices around the world, giving clients direct access to the deepest pools of capital. We put our clients first, delivering tailor-made strategies to achieve superior results.
Welcome, everyone, to another episode of the Insider's Edge to Real Estate Investing. I am your co-host now, James Nelson. I am head of U.S. investment sales. And Kim?
Good morning, everyone. I'm Kim Troller. Welcome. Today we have Agustin Barrios Gomez joining us from Mexico City. He's the founding partner of International Capital Partners, or ICP funds. Agustin, thanks so much for joining us.
Thank you, Kim. Jim, it's good to see you guys.
Yeah. And just as a brief intro, Agustin, like I said, he's the founder and president of ICP Funds. They're a commercial real estate investment firm focused on office and industrial in several cities across the U.S. He's between Mexico City and Houston, and also happens to be very involved in politics, and he's a public speaker on issues related to international investments in North America. So he's got a lot of wheels spinning, and we're really excited to kind of dig in and hear more about it.
Thank you very much, Kim.
Yeah, so Agustin, maybe just for our audience, if you could just give a background of ICP, maybe just tell us a little bit about what the platform is. And I know that there's some different verticals that you're invested in, so maybe just kind of give a sense of the overall portfolio.
Right. So we're a private equity fund based in Houston. We buy industrial and suburban corporate office assets throughout maybe 14, 15 cities across the U.S. Our strategy is we're very cash on cash focused. We're cash flow focused. We buy core plus assets. These are stabilized buildings. Our weighted average lease term is upwards of 6-7 years. We have 90 properties in 14, 15 markets in across the country, and we have We have a perfect track record. We've been around for about 9 years. It's a fund that's, we curate our portfolio very specifically in terms of our industrial assets. These are buildings that are between $10 and $30 million, mostly. In terms of our suburban corporate office assets, these are buildings that have some element of, mission critical. For example, we have portfolio of properties in the Denver Front Range area that have significant SCIF space, right? That's sensitive compartmented information facility, which means that all of these suppliers to the DoD have to do these business processes within these spaces that have specific build out, so that that they block electromagnetic frequencies and all that. Anyway, so this is all what we try to do. We try to make it such that our portfolio has particularly sticky tenants. This is a cash flow portfolio. We're very, very conservative in our underwriting. We stay away from markets that have had speculative activity. We stay away from what are the traditional gateway markets, simply because when you do your underwriting for those purchases in the New Yorks and the Californias and the Miamis and these markets that have other elements of market demand going for them, then you have to assume that there's going to be upside. And in our underwriting, in our projections for the yield that we're looking to give our investors, we're very conservative. We assume we don't assume anything in terms of upside. We assume that we do our underwriting based on what's in the lease contract, the rent bumps that we have already established, and so that keeps the flow very, very steady. It keeps our investors very happy. Again, we've been able to we went through COVID and we were able to hit our objective on time and on target. Currently, we've got a 9.5% yield per annum. And so we believe that this is the part of the portfolio that you can count on when other things are going a little haywire.
Right. Yeah. So generational wealth, if looking to build and protect your wealth, real estate is a great vehicle to do that for many, many people. What does that term generational wealth mean to you? And how have you used real estate as a vehicle for building that for yourself and for your investors?
Sure. So, I mean, for us, what that means is basically, it's capital protection and yield. And it's that sweet spot between the capital protection aspect of it, where you actually own the underlying asset and all of that. But at the same time, we're looking to make sure that our investors do have that yield that is attractive, and that they can actually, it's the whole sort of live off your rent strategy, right? But we believe that this is a more intelligent way of doing it than buying direct. So because it's interesting, we've developed we have this niche in all of our markets, in the Houstons, the Dallases, the San Antonios, the Denvers, the Chicagos, St. Louis. We have property in Detroit. We have a property in Lexington with long walls. And what we found is that there is actual value to be given, to be provided for your investors based on having a great reputation. So in all of these markets where we're active, and we're constantly and consistently active, what we've been able to do is be very clear to the selling population, right? To the ecosystem that sells in all these different local markets. And the way we do that, we're very clear that we're not going to go against institutional money. If you have someone with deep pockets going after your property, we're really not interested. We're looking for those double-digit cash, levered cash on cash returns. If we're not able to hit that with your property, we shouldn't really even be spending time on it. And what's great about that, in exchange for all of that, we do give surety of close. We've closed every property that we've ever put under contract on time and on target, except for a couple that have had issues with DD, of course, right? That's something that's completely out of our control. Mm-hmm. But they know that, right? Sellers in all these markets know that. And because of that, we generally buy off market, and we generally buy below market prices. Why? Because they prefer to sell to us instead of being, 60, 75 days out after this whole, after the whole purchasing process, and finding out that the buyer, in one way or another can't perform. And so I think that it's a great deal for the sellers. It's a great deal for us. It's a great deal for our investors. And that's how we focused it. And so the way that we look at it, and I was at a family office conference in San Diego last week, upwards of 50% of the portfolio for family offices these days is actually concentrated in private equity of one sort or another, right? So alternatives, if you want to look at it that way. And so we found that family offices, high net worth individuals working through, private banks and all that, they'll have the classic bond and stock portfolio that are the publicly traded securities, of course, and as investing 101 will tell you. But at the same time, they're very, very interested these days in having those alternative products that that are not correlated to the ups and downs of the financial markets. That for them is very important. And so when you have a portfolio of properties that has the underlying property, but that really depends on these credit tenants, one way or another, paying the rent. And we believe that has allowed, and it certainly has allowed during the last 9 years that we've been around, to have these uncorrelated returns. And so that's the way that family offices are looking at all of this. Obviously, in that space, you have to include VC money, right? I mean, there's a lot of people going in and investing in these venture capital products and early stage investment, and now you have tech and all of that. But within that basket, you also have funds that are much more conservative, that are much more geared towards providing a current return, as opposed to the these spectacular IRRs that are promised by a lot of other funds, right?
Mm-hmm. That's really helpful background, and that makes a ton of sense with your investment philosophy. If we could just take a little bit of a step back to understand your position within the transaction. So you come in as the equity partner. So you're always going to have an operating partner who's going to actually be running the day to day. So are you, typically you see these 90-10 deals, you've got major decision-making rights. I mean, are you always the majority equity partner who has that decision?
Always.
Okay. So that's really, so tell us kind of a typical deal profile, because again, if you're investing in properties that have great tenancy, credit, WALT, I mean, are these deals, maybe just share with us what the capital stack looks like as far as how much is financed, how much equity you're putting in, and how much you look for your operating partner to contribute.
Yeah, absolutely. So yes, we do work through local GPs. We have 9, although there are 3 that are most dominant within our portfolio, because these are the ones that work in the geographic areas where we're most active. So about 50% of our portfolio is actually in the Texas Triangle, and that is basically Dallas, Houston, and San Antonio. We don't buy in Austin because we believe that Austin often can show a lot of the market dynamics of a sort of sexy market that we're not all that interested in term because of the whole speculative aspect to it. So 50% of our portfolio is there. So of course our Texas GP is particularly important. We're very clear. So we're I guess I've heard it called a controlling LP, and what that means is that we're very clear with respect to what the benefits are for the sponsor. We are major decision making obviously is always kept in our hands. We are always by far the majority investor. We we'll do from 99.1 we'll do 99% to say 75% if the GP brings someone that a local investor that brings some value to the operation, then we'll contemplate that. But of course the conditions are always the same, right? The promote's always the same, and all these different. So we look for debt, and that debt is generally between 60 and 65%. There are 3 main sources of debt for these types of transactions. You have regional banks, you have life cos, and you have the big financial players normally out of New York that do the CMBS loans. And so maybe 9 out of 10, Probably about 7 out of 10 are regional banks. We like working with regional banks. We believe that regional banks bring a lot of local expertise. We also like them because we can give them a call if anything comes up with respect to the tenant, with respect to the building itself. This, at the end of the day, this is still very much a relationship business. You still have to know who you're talking to. You still have to know the players at the local at the local level, and regional banks really do give that those benefits. And then of course you have life cos. Life cos are great when you can line up the WALT with their needs, and so sometimes they offer some really good terms. And CMBS is, when you're basically clipping coupons for 18 years from, a credit tenant, then a CMBS loan might be interesting. But those are very, very few and far between, because as you know, the CMBS loans can be very complicated if you actually need to talk to somebody, because of course, these are syndicated loans, and so there's no one holder of that debt. And so we're leveraged across the portfolio to about 63%. On a weighted average. It's on a deal by deal basis. There's no cross collateralization. Basically, there's also there's no recourse on that debt, simply because, of course, we couldn't have that. And so we've been able to finance our deals at attractive rates. And what's great also by being an evergreen fund, which is what we are, that gives us the ability to, on the one hand, it separates us from funds that are project by project based. It gives the investor immediate diversification, and it also allows us to buy in all environments, right? So we've been very successful at buying in low interest rate environments, and very successful in buying it in high interest rate environments with higher caps. And so, generally you're looking at financing when the markets are a little bit more jittery. You're looking at say a SOFR plus 225, 230, 240. And when markets are a little bit more calm, like they have been lately, and there's more capital being deployed on behalf of the banks and the debt, you're looking at maybe a SOFR of plus 180. So as long as you've got that delta between the cost of your capital and the yield, then you're able to give those returns that are attractive to investors.
Okay. So from what you've described, it sounds like you have a very long-term investment horizon. You're focused on cash returns.
We do. And nevertheless, we also believe, and this is important, I think, one of the things that investors tell us is that they don't like long lock-in periods, right?
That was where I was going. Yeah.
And because there's no development risk, we don't develop. We'll do a lease up, but when it's very, very clear what the exit is and what we're looking at, maybe 85% occupancy, nothing really, out there in those terms. So we might do a lease up, but and there might be a little bit of a value add play on some buildings where it's very, very clear. But the in place cap rate has to be attractive from, again, from the get-go, right? It has to make sense. It has to be accretive. It has to make sense from the get-go. We have to be able to get our returns from the starting bell, so to speak. And at the same time, we have enough. We have about 450 investors at this point. And so there's enough movement within the portfolio so that we can offer our investors their exit after a 2-year lock-in period, which we believe to be very, very reasonable. We can offer them exits, to liquidate their positions within 3 months if it's below a certain threshold, and 6 months if it's above a certain amount.
Right. Well, as opposed to stocks and bonds, real estate is an illiquid asset class, and with that comes an illiquidity premium, which a lot of investors who are willing to be patient can reap the benefits
Absolutely.
of.
And there are several sources for those for that, right? I mean, you have incoming investment, which fortunately tends to be enough. There are lines of credit, and of course, at the end of the day, you can always go out and sell a building. But as investors know, when an investor of a certain size does seek to liquidate, based on a sale, they're the ones that have to take whatever loss is on the table if that's what happens, right? I mean, because I think, investors have to be aware that, like you just said, Kim, these are illiquid assets, but at the same time, that's what makes them attractive. That's what makes them solid. That's what makes them real, so to speak.
Right.
I'd love to
Bank
understand
paper.
a little bit about how you get comfort with the various tenants in your portfolio, and if that really drives. I mean, I know, for example, Amazon is a very big tenant in your portfolio. I know you also
Actually, they're very, very small.
Oh, they're
We
small.
do have
Okay,
them.
but I saw you
and that was an interesting deal. That was and maybe I can answer your question with respect to counterparty risk. Right, at the end of the day, counterparty risk is very much the name of the game. And there are two ways to mitigate that risk. There's the multi-tenant way, right? We have in our portfolio a flex product, where you might have 30%, 40% of the GLA office build out, and then the rest is, light industrial or warehouse distribution. So, we call that sort of lunchbox real estate. Like, you have these local, plumbers, electricians, and all that. We have some of that in Texas, and we find them to be amazing tenants because nobody's building that space, and two, you do have a lot of these local contractors and these types of tenants that are doing very, very well, and they need that sort of space, and you can actually charge a premium because, of course, these are not credit tenants, but you have a diversification in the property that banks like. And that's another element with respect to debt that we like. When you're making these purchase decisions, you're making them hand in hand with normally a regional bank, and so you can gauge the temperature of the tenant mix just with the back and forth that you have with your finance partner, right? And oftentimes when you have a property that has a diversified base of tenants, even though no one of them is national credit, nevertheless the credit risk is fairly low because of the diversification within the asset, and at the same time because their individual balance sheets are actually quite good, right? And then of course you have the national, you have the credit tenants, the proper credit tenants that you can have. We just bought a 2 property portfolio for a German, automobile manufacturer, supplier, one of these tier 1 OEM manufacturers for, that they supply pretty much everybody in the automobile industry with sunroofs and drop tops and all these different things. And so that's a German company that's been around for 125 years, and they have a plant in Lexington, they have a plant in Detroit, and that's a sale and leaseback, which we love, by the way, that's 18 years, right? And so that's a very specific type of credit risk, and that's a very specific type of SLB, sale and leaseback opportunity.
So how do you because it's really interesting that in some cases it might be better to have kind of the multi-tenant mom and pop than just say one Amazon tenant, right? So, but regardless of the tenant, how are you getting a comfort level with the credit? And then what type of return are you looking for in return? I mean, obviously, if you have a credit tenant, that's going to warrant, for most investors, are willing to accept a lower return. If you sell in the future, you're going to get a tighter cap rate. But how do you really, I mean, is it just going to Moody's, S&P, trying to figure out what the credit rating is? I mean, with these private tenants, how do you get comfortable with their shadow credit, if you will?
Well, it has a lot to do with their particular activity. So, I guess the classic comparison is with retail. We do not do retail, but the classic comparison is, with the nail salons and the the cleaners and all these different people in the retail side. That's a very specific type of activity. When you're dealing with industrial product, when you're dealing with flex office industrial product in the local markets, with surface parking, but you might even have overhead doors, for example. Generally, these are businesses that have been around for a while. They're family. They're certainly mom and pop in the sense that they're family. But you'd be surprised at the amount of money that they represent. right? I mean, these are generally, they'll have a monopoly over certain things as contractors, for example, within a region, because as you know, these are very local businesses. They will have been around for a long time. They will have, a very attractive balance sheet. They'll have very, very little debt on their books. And at the same time, because they're like you say, shadow credit, if you want to look at it that way, they also tend to pay, a premium in terms of rents, which makes it, all the more attractive. And at the same time, the element of diversification, that is also very, very important. Like you might have 30 of these types of tenants in a flex office industrial building that's a single story, surface parking, overhead door kind of, situation. And of course, you're doing this hand in hand with the regional banks. Oftentimes, these businesses will actually have relationships with these banks, so the bank will be comfortable also with that credit, because they will know these people personally, and that's acting at the granular level, of course.
Augustine, what is your reasoning for staying away from retail? We've noticed just from our internal reporting that over the past few years, there's been an oversupply in assets like industrial and multifamily. But from a rent growth standpoint, retail is in a really great spot, particularly bricks and mortar retail. Why not retail?
Originally there's a sister fund that operates in Mexico that has Walmarts and has significant amount of retail, that I have business partners that have that fund. And when we looked to launch ICP, that was sort of a natural way to do things. But what we saw was, retail has different dynamics. Often, the property will be very specifically built out for the tenant in retail. We didn't see that with that, with that customization necessarily we would find the commitment on behalf of the tenant in terms of the length of the WALT for it to really make sense. Which doesn't mean that retail isn't a great business. It certainly is, and more power to those who are in that business. But when we were looking for stability, when we were looking for properties that really, that could turn on a dime in terms of finding new tenants, but that had very sticky tenants in the first place, we actually found that industrial, and specifically, mission critical suburban corporate office, because office is a huge, it's a huge space. And suddenly, you hear, oh, office is doing terribly. Not all office is doing terribly.
Right.
And in fact, when during the pandemic, when it was sort of the height of the office crisis, because our office properties were truly mission critical, we actually didn't see any issues with the 47% of the portfolio that is made up of office. And so I think you have to know what your property is about, right? I mean, you have to know if the tenant is actually using it as a sort of a cookie cutter space that they could take it or leave it. Right. Or CBD office, for example, that's still having its issues, in particular, 90s and 2000s product, that you have these amazing buildings. I mean, some of them are like, brutalist masterpieces and like that style, or these sort of, glass CBD towers that are also very iconic. But if they're not full on AAA, if they're not, full on top of the class office product, there's very little demand for them. We never got into that, right? It just didn't fit our profile. We were always in these suburbs that have, the market dynamics where you have, for example, the C-suite that lives very nearby, or right, the employee base that also, that you wouldn't want to send them 40 minutes further west or east or whatever, right? And so there's another reason why they're there. SCIF space in those markets that are related to national security and Department of Defense, like the fact that in Colorado Springs, which is one of our markets, you have the Air Force Base, and up until now you had Space Force and all of these different things. In Denver, for example, I don't know if you know this, but Denver is the sort of capital of the West, apart from California. Of course, California is its own world, but Denver has the highest concentration of government buildings outside of Washington, D.C. And so you have these, defense contractors out there that have a bunch of rules around them with respect to where they do business. And so these are the stickiest of tenants, despite the fact that these are office buildings, right?
Interesting. Agustin, maybe you could talk a little bit about your partners. So I think you said you have 9 different partners,
9
3
GPs,
repeat
right.
partners, especially in Texas. So, what do you look for in a partner? Maybe how did you end up connecting with them? And then, maybe there's someone who's listening to this show right now who has a great opportunity and they say, hey, this perfectly matches, ICP's deal parameters. If someone just reaches out and says, hey, would you have interest? Does that ever happen? Or is it more kind of debt equity advisors who are kind of help matchmaking for you? How do you find your partners?
No, so it's been very organic. So we started out in Houston because just for family reasons, my former father-in-law had been developing in Houston since the 1970s, and that was where we started out. And we still have a good, what are we at? Maybe about 30% of the portfolio in Houston. We love Houston. We think we love the business dynamics there. And so we were looking at a property. It was one of the first properties that we were looking at that we ended up not buying. But we were introduced by the broker, the seller's broker, because we were looking at the property. We said we had a GP in tow, sort of a small 2-man operation that was going to be the GP that had a lot of experience, but they hadn't actually created their built out their business since the guy left this massive sovereign wealth fund where he had managed a large portfolio. And when we told the seller's broker, we said, this guy can't perform anymore. We're going to need somebody to pick up the slack. We're going to need somebody, to perform the duties of our local partners, which are generally, procuring debt and a lot of the property management, that sort of thing. And he was the one, this seller's broker from JLL. He was the one who put us in contact with this group. And in particular, in with respect to our GPs, what we look for basically second or third generation local players that have a really good reputation, that have incredible local contacts, that have done a good number of deals, but we don't want them to be like these multi-billion-dollar operations that have done all these deals with institutional money, because that's not where we play, right? We're not looking at deals up north of, $30 million, even $30 million. We curate our portfolio. We're not deploying enormous amounts of capital, which is the reason why we're able to buy at the prices that we're able to buy, because we really are looking for, we're cherry picking in a very aggressive way in many ways, but very aggressive. No, actually, I wouldn't use that word. It's not aggressive. What it is very open, very clear, very transparent. We're working to hit double-digit levered cash on cash, and we will give you surety of close, but you're not going to get top dollar, right? But if you're serious about selling your property, if you're serious about selling your building, we will give you a fair price for what is for us a fair price. We're also not going to be overly aggressive with respect to, it's not that we're trying to squeeze the last dollar out of you. It's the fact that we have a commitment to our investors for a certain level of return, and we're very clear. And so it's very funny because sellers actually really appreciate that. It's been surprising for us that we have been in in what is in many ways such a perfect market. There is the market dynamics. I mean, commercial real estate in the United States is by many measures the biggest asset class of any kind in the world. Maybe China might be bigger, but of course China has its own thing, right? So in terms of asset classes, commercial real estate as a whole is perhaps the largest asset class in the world. And so, you would think that it's a perfect market, but it's not. There's still a lot of there is still a lot of value to be had with those personal relationships, with your, with a reputation, with giving the seller certain guarantees in terms of the fact that they will close on time and on target. And that represents millions and millions of dollars for our investors. And that's the reason why we can give these returns, or we have been able to give these returns up until now, since inception, because we have found those deals. So we curate them in that way. So again, our GPs, our sponsors, they have to have those qualities about them. These, generally these are second or third generation players, very well known in the market. They know everybody in the market. They can sit down with the debt providers. They can sit down with the sellers, and everybody knows them by name. Those are the people that we like. And of course, they understand that they're not going to. This isn't a one and done sort of situation. They're I think, in an ideal environment, everybody does very, very well. But at the same time, it's not a get rich quick scheme. We're not looking for, to sort of kill it with them such that everybody gets this massive promote and all of that. That's not where we're about. We're about consistency. We're about, this is a marathon. This isn't a sprint.
Right. So on that note, let's talk about foreign capital. I know you work with a lot of international investors, and I'd be curious to hear about what sort of draws foreign capital to the U.S. We know that foreign investors often have a different deal logic than domestic. Maybe if they're trying to get their capital out of their country, deals that might not make sense for a U.S. investor might actually pencil for them from a yield standpoint. Is that something that you're seeing with your investors?
So yes and no. Generally, when the foreign investors that we deal with tend to be very sophisticated investors who are already in the U.S. They oftentimes, and this is something that we prefer, to be honest, they have their own investment vehicle. They have their own C corp in the U.S. and we can give them their K1 and everybody's happy, right? And because at the end of the day, the vehicle, the actual investment vehicle is a pass-through LLC, right, with its SPVs and whatever underneath. And so if the foreign investor, even though they will be a foreign investor from the perspective of the fact that the ultimate beneficial owner is international, they will have some sort of U.S. investment vehicle that tributes in the United States, that has a real presence in the U.S. and has its own operation, a C corp, right? Not a pass through. We don't do, we can't have another pass through. We need to have an actual C corp, check the box LLC, however you want to call it. And so that they tend to have very similar dynamic to the U.S. investor. These are people, family offices like out of Monterrey, for example, Monterrey, Mexico, which is a very, it's a wealthy industrial city that's been around since forever. It's part of the region in terms of Texas. Like that whole region is really very integrated. Obviously, used to be part of the same area. So, people are very comfortable with the San Antonios and whatever, because these family offices, the owners will have their beach house in South Padre Island, right? And so it's not foreign to them. It's part of their, maybe even half of their family will be on the Texas side, so to speak. And so for them, they get very comfortable very easily with these sorts of trades because they understand the market dynamics. And these are all obviously sophisticated investors. These are all accredited investors. And so we're just, we're what we offer them is diversification. So a lot of these family offices would normally be considering buying, for example, power centers and all of these different things in places like San Antonio. But the issue is that if you actually do the math, I mean, if you're a family office, no matter how large you are, I mean, I guess there are very, very large family offices, but the classic family office doesn't have that amount of their portfolio in real estate for it to make sense, right? Our best investor is the family office that's willing to sit down and actually do the numbers, because we will show them that buying direct will concentrate their risk. They have to have a team of people to actually manage these properties. So you just there, you're talking about $500,000, $1 million a year in salaries and sunk costs just to handle the portfolio. Those are expenses related to your investment. So when they're willing to sit down and not just isolate the trades and say, oh yeah, we bought this power center for whatever, and we sold it for 50% more 4 years later. But if you actually sit down and do the numbers, generally you're looking at 4.5%, 6% returns in the best of cases. And so when you can actually go through a diversified fund with very reasonable fees and have that diversification and have, we look at deals that are just not available to these family offices because we're in the market constantly, because we do have our reputation. Mm-hmm. And so I think a lot of these investors have actually had the bad experiences, which is certainly a pity, but for us, it's actually a great benefit, because they do see what being out there really means, right? And that you can get bruised out there very, very easily, because it's not what you do on a day-to-day basis, right?
Are you only acquiring assets through the fund structure, or do you also do single asset syndications?
No, we only acquire it through the fund structure. Yeah.
So,
which also plays into what you were asking about retail. That's another reason, we specialize. We believe that you're best served by staying in your lane, so to speak, and being the best at what you do, which is what we try to do every day.
So, Agustin, going back to what you were saying before, it's almost as if ICP becomes the outsourced family office for some of these investments. And I'm just curious, what is your organizational structure? And I noticed you were at Harvard Business School executive program for real estate management. And so, how have you built your company? What does that look like? And then how do you spend the bulk of your time as the founder?
Yeah. So, there are two main things in this business. One is raising capital, and the other is buying properties. Well, three if you want, because there's obviously an administrative part, an ongoing administrative part. Basically, what you want so there's a management company, and the management company is the company that actually charges the fee to the fund, right? That's the business. That's what pays for the plane tickets and the office and all that. And within that management company, we have every aspect of the property and asset management and income distribution, of the finance side, the property management side, the asset management side, represented. So you have this core team of professionals, about a dozen of them. And these are the people who make sure that everything works, right? And they have individual counterparts within the sponsors, right? So there's somebody in charge of pipeline, for example, who's contacting their counterparts in sponsors and GPs every day or several times a week. Same thing happens with property management, because we keep decision-making powers ourselves. So we're constantly giving follow-up to the parts of the sponsor team that work on the tenant improvements, the leasing, all of these different things. You have this sort of mirror organization within the management company that replicates the abilities of the GPs internally, and then of course, but it's the GPs that have to deal with this on a day-to-day basis, right? And if it's if they're single tenant or just 2 or 3 tenant buildings, then oftentimes they will ask to keep the property management in-house. And they're generally very good at that. And then, of course, you have multi-tenant deals, and these are parts of the negotiation with your debtor with your debt provider. Sorry, that you'll have to hire a Lincoln Properties or one of these big property management firms and pay them the 3% of NOI. But as you know, all of these rates are very standard, right? No, nobody's taking advantage of anybody in that context. Everybody knows exactly how much these services are worth, and you're always paying market prices for that.
So, Augustine, one of the best parts about real estate is that it's interdisciplinary. And I know you have a background in politics.
I have a background in everything. I had a nightclub in my 20s.
Yeah.
Brand.
I'd love to hear about how those experiences have shaped your real estate investment philosophy.
Yeah. So, at the end of the day, like I mentioned previously, this is very much a relationship business. So yes, it's a real estate business, but it's also but it's very much a finance business. So one of the wonderful things about working in US real estate is that it's all so organized, right? So when you're working with your Argus, right? When you're sitting in front of that Argus and you're doing all of your underwriting and you're working hand in hand with the debt providers and and with the tenants and your estoppels and all these different things, when you're getting all of this information, everything goes into a box. And you know exactly how much the property is going to be giving you over the next 10 years. Exactly. Why? Because you're making those reserves. The bank is automatically making those reserves. As you know, this is investors' money, but you don't have access to it. Why? Because you're going to have to replace that roof. You're going to have to replace that HVAC, right? And so it's such. And the level of security from the investor's perspective is wonderful, because these are things that are already baked into the system. And one of the things also that, if one of the reasons why we can often get great deals is because we are very conservative in our underwriting. So we will budget for, we'll make reserves for a lot of the potential contingencies that come up. And sellers actually like that also, because they know that when it comes time to close, there's not going to be any surprises from their perspective. So it might make the building cheaper, or rather it might make us less willing to pay top dollar for a property, but at the same time, we're being realistic from the get-go. And so, all of these, I guess, interdisciplinary things are they're certainly important. I mean, you've got to do public relations in one way or another. You've got to do sales. You've got to do, you've got to be conversant with what the investor is looking for. Also as an individual, my father was very successful in media, but he was, and so when he had a stroke when I was 23, and I had to sort of from one day to the next had to, become conversant in asset management, and I'm an only child, and all these, my mother, for all practical purposes, was a widow at 54. My personal experience, and I made a lot of mistakes during those first years, obviously, right? That personal experience plays directly into this, right? I've made the mistake of buying, the condo and renting it out and thinking that it's a good idea, right? Sorry to mention that, and I'm sure that it's worked out for a lot of people. It certainly didn't work out for me, and I've seen a lot of people get burned on those beachfront condos because, they think, oh yeah, it's going to pay for itself. Yeah, sit down and really understand what that means. Look at the fact that you're, in the Miami market, for example, you're paying 10% to the broker just to place the property. You've got taxes that you weren't thinking about. You've got insurance costs that are going through the roof. You've got potential contingencies on a single property that are going to really affect your cash flow, if not do away with it altogether. So I made those mistakes at the beginning. And why? Because I did it with my own money, and that's just the way the cookie crumbles, so to speak. But eventually you realize that we're not that different. Investors are not that different. Once you start talking about family wealth, investors are really not that different. They all want a part of their asset allocation to be not directly correlated with the financial markets. They all want a certain amount of return, but the capital protection. We all want that as investors. I myself am an investor in my fund, And that's what I'm looking for. In fact, to be honest, the gestation of this product actually was based on my own experience, right? I mean, when you're working with private banks and during the great financial crisis, and you realize that, one of these major banks that has this incredible reputation, sold you Madoff products, right? And you realize that oftentimes, what you really do believe to be safe isn't really safe. That's when you start asking yourself, well, where is the best place to get that capital protection and those returns, right?
Absolutely.
So anyway, that's kind of my personal experience, and that's what played into this.
No, really good points there, and appreciate your sharing how you had to really essentially figure this out for yourself first, and then kind of open up the opportunity to outside investors. So as we begin to wrap things up here, and just, looking again at the diversity of your experience, and for those listening right now who might not be from the real estate space, that could be a student who isn't majoring or going for a master's in real estate. I see at Georgetown, you had a degree in international law. Then you went to Madrid Law School, where you studied on public policy. Talking about a path towards real estate investing, I mean, the fact that you have this diverse experience. The one other thing I wanted to mention for your bio was you work for Procter and Gamble, which is notorious for having
brand
the best sales and brand management. So, I guess the question is for someone who has kind of this diversity of experience, how do you see that as a strength, as opposed to someone just taking that direct focus where, okay, I'm in college, I'm going to intern every summer at a real estate shop, and I'm going to go get my real estate master's degree, and then I'm going to go be an analyst, and then I'm going to go do acquisitions. I mean, there's a very kind of defined path, traditional path, I guess, if you want to do real estate, as opposed to maybe learning about the law, maybe learning about public policy. So any thoughts about kind of differences in approach and having a more diverse experience?
I mean, I think everybody has their own individual path. I think it's extremely valid and extremely valuable for those people who from, when they're 18 and about to go to college, love the idea of getting into the real estate space as a space that has been up until now a consistent source of wealth creation, right? But from my perspective, independent of, whether I was a brand manager at Procter and Gamble or all of these things that, or going to Georgetown at School of Foreign Service and all of this international stuff, from my perspective, the experience that really drove me into the space was my personal experience from an from like a personal financial management perspective. So in my case, there was generational wealth. And so when I was suddenly, pushed into that, I had to pull from all my experience to see what I was going to do with that. And this was, this was a long time ago, obviously. Fortunately, I learned. But, it was that there are two ways to come at this. One, the very professional, specific path, studying it, going into a real estate shops, either at the GP level or at the fund level, or, at the broker level, for example. I mean, these huge national brokers, the CBREs of the world, they have these amazingly well-versed people inside their shops. And if you can, be successful in that space, that will give you an incredible breadth of knowledge of the space. Or there's the life experience space. And I think, curiously enough, I think real estate has a lot of life experience people in there. The classic people who have built their wealth in one way or another, and then they realize that real estate is just, a great place to protect your capital and to have yield. And they're graduates of the University of Life, and they learn on the go. They'll burn, they'll buy that lease up property in the Bronx, for example. I'm mentioning that specifically because I think you guys are in New York, and so I was in San Diego at a family office conference, and just now there was this other conference that I was at a resort here in Mexico, and I spoke to two different people who were, very, very successful people from the Bronx, these classic, one was Italian, the other one was Jewish. And, these men who in their 70s and 80s who just, they started buying these properties locally in New York and eventually created these incredible portfolios and stuff. They didn't study any of this, right? And but they're probably, I don't know them. I don't know their portfolio individually, but I'm guessing that they're probably some of the best, business people in the space out there, right? And they're very, University of Life people, right?
Yeah.
So from my perspective, I think it's also very important that for me individually, it was very important to know what I was looking for in order to protect, whatever generational wealth or patrimony, and it's a direct translation. In Spanish, it's called patrimonio, which is a great word you have, and know what my needs were and know where my pain points were as an investor, right? Know that I had been, I had been with these very renowned financial institutions, and I had been stung, and it's that personal experience that I bring to the table that says, it's time to find something that suits my purposes, my family's purposes, and I think it's going to suit your family's purposes as well. Right.
Wow.
Right. If everyone we worked with came from the same background, not only would our day-to-day be extremely boring, but I think we would lose out on a lot of creativity that we have in
100%.
putting deals together. You need diverse perspectives.
No doubt.
Absolutely.
Well, Augustine,
Absolutely.
this has been fantastic. We so appreciate your sharing your story, and again, incredible takeaways. So we really appreciate your joining us today.
It's my pleasure. Have a wonderful rest of your week.
Thank you. And for all of those listening, especially on the live stream now, we really hope this was a benefit to you. And for those of you who'll be listening, once this comes out through your favorite podcast channel or maybe on YouTube, the best thing we find is that you can just share this episode with someone who you will get benefit from. And Augustine has shared so much knowledge here that we know that there's a lot here to capitalize on. So as always, you can go to jamesnelson.com. This site is not about me. I built this for you. And this is where you can find the show notes. From here, you can find out how to connect with Augustine and about ICP, as well as a lot of other helpful tools, instructional videos, white papers that I author on Forbes, and soon a course that's going to be coming out on real estate investing based on the book, The Insider's Edge to Real Estate Investing. So with that, we appreciate your joining and have a great week. Until then, thank you.
Thanks to both of you.
Thank you for listening to The Insider's Edge to Real Estate Investing. We appreciate your subscribing and sharing with your friends. If you haven't already, please connect with James at James Nelson NYC on LinkedIn, Instagram, and Twitter. Please also visit jamesnelson.com, where you can sign up for our monthly newsletter, find the show notes, other episodes, exclusive video series, and other helpful resources so you can gain the insider's edge to real estate investing. Until next week.
This podcast is for educational purposes only and should not be relied upon for investment decisions. The opinions expressed are those of the guests and not their companies. Listeners should not act upon the information without first seeking appropriate advice from an accountant, lawyer, or other professional.